What if my business sells to Canadian provinces with PST instead of HST? Many US businesses assume that Canada has a single national sales tax system. In reality, you are dealing with a federal GST, HST layer plus separate provincial systems. Some provinces have harmonized with the federal government to create HST, while others run their own provincial sales tax or PST alongside the 5% federal GST. If you sell to provinces like British Columbia, Saskatchewan, or Manitoba, you are in PST territory rather than HST territory. That does not mean you can ignore tax. It means you may need to handle both federal GST and separate provincial PST registration and collection depending on what you sell and to whom. PST provinces versus HST provinces. Canada splits into two broad groups. HST provinces such as Ontario, Nova Scotia, New Brunswick, Prince Edward Island, and Newfoundland and Labrador have combined the federal GST with a provincial component into a single HST rate. Non-participating provinces and territories, including Alberta, British Columbia, Saskatchewan, Manitoba, Quebec, and the territories, apply the 5% federal GST and then may apply their own provincial tax separately. British Columbia, Saskatchewan, and Manitoba levy standalone PST at their own rates and under their own rules. Quebec uses its own system called QST, administered by Revenue Quebec. In these provinces, HST as such does not exist, but GST still does. GST-HST still applies federally. Even in PST provinces, the 5% federal GST still applies to most taxable goods and services supplied in the province. For non-resident businesses selling into these provinces, the federal rules about carrying on business in Canada, the $30,000 threshold, and the new digital economy rules still matter. That means your first layer of analysis is federal. Are you required to register for GST, HST based on your Canadian taxable supplies? If yes, you charge 5% GST on supplies to PST provinces instead of charging a harmonized HST rate. The place of supply rules still decide which province a supply is made in, but the rate in a PST province is normally just the federal GST rate. When do you need provincial PST registration? PST is not administered by CRA. Each PST province sets its own rules about when out-of-province or foreign sellers need to register and collect provincial sales tax. The general trend is that if you are selling taxable goods, and in some cases certain services to customers in that province, and you meet specified thresholds or connection tests, you may be required to register for PST as a non-resident vendor. For example, Saskatchewan's PST applies to taxable goods and some services consumed or used in Saskatchewan, and out-of-province sellers can be required to register and collect PST when they sell to Saskatchewan customers. Similar ideas apply in British Columbia and Manitoba, but the details, thresholds, and registration processes differ by province. Selling goods into PST provinces. If you ship physical goods from outside Canada or from one Canadian province into a PST province, you may have three tax angles to think about. First, you may need to charge federal GST at 5% if you are registered or required to register for GST, HST. Second, you may need to charge PST if you meet that province's non-resident registration rules. Third, if you do not charge PST, your customer may have a self-assessment obligation on the provincial side, which they will not appreciate if they expected tax to be included. Because PST is not a value-added tax, you generally do not get credit for PST paid on your own purchases. It is a cost, not a recoverable tax. That is one reason US businesses sometimes underestimate its impact when expanding into PST provinces. Digital services and PST. For digital products and services, some PST provinces have extended their rules to capture non-resident vendors. For instance, digital software or telecommunication services used in the province can be subject to PST even when supplied from outside the province. The exact scope and registration rules are different in each province and have been evolving as governments respond to changes in the digital economy. This means a US business that has already registered for GST-HST under Canada's digital economy rules might find that it also has to think about provincial obligations in PST provinces, especially if it has many customers there. Practical implications for U.S. businesses. If your U.S. business sells into both HST and PST provinces, you need to stop thinking of Canada as one tax zone. At a minimum, you need systems that can handle GST, HST rates correctly by province and a separate layer of logic for PST or QST where required. In practice, that often means different registration numbers, different returns, and different deadlines for each PST province where you are obligated to collect tax. Ignoring PST because it is just provincial can lead to provincial assessments that stack on top of federal GST, HST issues. The amounts can be meaningful once your Canadian sales volume grows. Final thoughts. Selling to provinces with PST instead of HST does not mean there is less tax. It often means there is more complexity because you have a federal GST layer plus separate provincial PST systems to understand. For US businesses, the safest approach is to address federal GST, HST registration first, then review each PST province where you have real sales volume to see whether local registration is required. If you want more help mapping your actual sales patterns against Canadian federal and provincial rules, you can explore our website for deeper guides on cross-border sales tax compliance. If you require assistance with Canadian tax matters, our team is ready to provide reliable professional support. Please contact us at 416-283-8774 or visit theaccountingandtax.com for more information. And if you found this video helpful, don't forget to like, subscribe, and share.